always say it's the behavior, it's not the score. 432 or 435 score. Got 11.99 interest rate. As much as TransUnion or Equifax shows it may not be late, but internal, it could be late. At the end of the video, I'll be doing a giveaway, so stay tuned.
Well, in the last episode, you mentioned about how credit score actually means favorability to the lenders. Let's say there are like two people coming in, one with 700 score, one with 500 score, but in some cases, the 700 score actually get like worse deals, quote unquote, late with higher interest rate. What could be the reasons behind that?
How come, certain clients, with a 700 score or 680, 690, whatever it may have a not so good approval compared to maybe even 400 or 500 score. So in this episode, I'll highlight a little bit more, but I'll obviously give a little bit more detail into it. It's what I said earlier in the episode, know the devil you don't know, right? So someone, like I said, default coming to a country could be from, I've seen from 680 to even like 705, 710, 715. I think I've even seen 720 with, we call it no hit bureau, meaning there's absolutely nothing, or maybe you have a credit card for only a month or two. It's just the credit is so thin. Okay, so when it's so thin, again, to lender's eyes is, or even myself as a credit analyst, I'm like, okay, you came in, for sure your work permit, student visa, maybe even with the PR, status, you got a $500 card. You did it for 2 months. How I see it, or what lenders see it, it's like, okay, it's a honeymoon phase. A honeymoon phase means really, obviously, the first couple of months, first year or two, it's always sweet and lovey and dovey, always good. But it doesn't give me enough history to tell me you can really handle bigger loan. Because now if you're asking for personal 10, 15,000, or say a car loan, another maybe 20, 30,000, question now to the lender or myself is like, whoa, you just borrowed $500-$600 on your credit card limit. How did you 6 months want to ask $20,000, $30,000, $40,000 loan? The risk is extremely high. So now they value a lot of things. Again, now your income, stuff like that. If they like, okay, if you make good money, you suffice the payment, but I still don't know if you're gonna pay me back though, because credit shows me you're only able to handle a $500 loan. So what lender usually do, they cap the finance, meaning, you know what, I'll give it to you, but all you're gonna get is $20,000 max. Total amount finance. So everything all included, that's all you're getting. Your cap. If you want more, put more down payment. It's simple as that to offset the risk, right? Now, when I said the devil you don't know, so what if someone's like 600 score, 580 score? In fact, I helped the client long time ago, 432 or 435 score, got 11.99 interest rate.
Really?
Yeah, I know. A lot of viewers right now will be like, whoa, what do you mean? So again, all based on the credit character and the behavior. So this client, as much as, yes, the score was low, a lot of things happen, file consumer proposal, but ironically, the client has a good auto loan history. So again, previous episode, it's very divided. As much as the credit itself, what you all see, there's a mortgage side, auto loan side, and then the personal side. Personal side is more like cell phone, maybe like some, credit cards that's a little bit more lenient, stuff like that, which even people with 400, 500 score can get a cell phone bill easily approved, right? Car, same thing. So internal scores, banks and lenders have internal rating. Is this person or client have a good auto loan history? Wow. 5 years ago, this client paid it off or traded in. And then, wow, they paid it off again. They paid it off again. You know what? Yeah, maybe their cell phone's really late. Maybe they're very late on student loan. Maybe they wrote off 1 or 2 credit cards, but auto loan, some reason this client never do. You know what? I trust you more because it's 20,000 trading and now become 30. With carrying there, so the amount was getting bigger, and every single time it was on time payment. Oh, 100%. So treat this as this. If you and me, if you lend me money, I keep paying you back, but then I don't pay maybe my friends and family, but you don't know. But our relationship there is. So now from 5 to 10, 10 to 15, 15 to 100, 100 to 1,000, 1,000, and this course of decades and decades of history, right? So that's why lenders, I always say it's the behavior, it's not the score. I've seen a lot of interesting profile, getting approved, but it completely justifies. It justifies. It's very reasonable. So not necessarily, when you ask me, 600-700 score, it's a 6-7, versus 500 or so. How come that approval is so much, quote unquote, in comparison, a lot stronger and better? Because it's, again, know the devil than the devil you don't know.
Right.
Right.
That's so surprising to know. Does it make sense to say that building your credit score is kind of like building your trust with a person?
Exactly.
You need to show commitments that you're actually paying back that money.
Yep.
Let's say 2 people open their first credit card at the same time with the same limit. Why would one profile actually grow faster than the other one?
Well, everybody's different. It's very situational. So as much as it could be, let's just say a brother and sister went to the bank, opened the same card, same type of, say for example, student card, $500 Visa, same age, they're twins, all of that. But the difference is the spending habit. The spending habit will always be different. What you spent, what you buy is different. Maybe today you'll buy something at the cafeteria, the other brother or sister maybe buy something else, right? So the spending's different, meaning then also determine the paydays, your credit card or your loan or your cell phone and all of that could be vary too, right? Some could pay a little bit earlier, maybe 2-3 days after using. Some maybe want to wait until at the end of the month or around like the due date, they pay it off. It all varies. Spending habit different, the money they make may be different. Because of that will then lead to the spending habit absolutely for sure different, right? So that would definitely really one of the big reasons that does have a big change, or why is it different, even if it's same account, same twins, same birthday, all of that.
You just mentioned that when you pay your credit card is part of your spending habits. Is there actually a best or optimal way to do it? Because timing comes up a lot in those credit hacks videos.
There's no really right or wrong way. Obviously, just don't pay after the due date or even the day of. So yes, there's a little bit hacks. You might hear a lot of people online say, there's a 15-day rule and a 30-day rule. So let's just say you got a credit card, you have it, you signed up already, you already got it on January 1st. Now let's just say the credit card has a limit of $500. So there's a little hack-ish to it, is where on the 15th or the second week of before the end of the month or the due date, you pay half the balance off. Mm-hmm. So now it becomes $250. Okay. And then 3 days before the due date. So if it's a 31st of the month or February, sometimes leap year is 25th or so, make sure it's 3 business days before the due date. Because the reason why behind this is if the due date is on the 31st and 29th is, let's just say it's a Friday, you go pay it off at 5-6 p.m. Guess what? That business is gone. Saturday is not a business day because bank all closed. Sunday all closed. So now the payment just got through the following Monday, but Monday was the due date. So now in theory, you're kind of late. You're not late, but you're late.
Oh, that's how it works?
It's a funny thing. Like, it's how some people say, hey, you know why you have to come to work 15 minutes prior to shift? It's not coming at 9 a.m. and you start firing the computer, it's 9 a.m. you start working already. So it's kind of along that line, right? So I always tell clients before the due date, make sure it's like a 3 business days so they have time to register, because sometimes clients will go to a teller and pay their bills. Well, teller the bank actually won't finalize everything again until end of the day. Then end of the day, that become the next following day, right? And then next following day, then it reports to the credit card. So then now the credit card gets it. It has to be business day again, right? Now when they see the payment in, guess what? Now they also now have to update Equifax or TransUnion. Well, that's another business day, right? So that's why a lot of actually people don't know about this is as much as TransUnion or Equifax shows it may not be late, but internal, they could be late. So another example, let's just say there's a due date on an auto loan is today, Monday, Tuesday, Wednesday, it doesn't matter. You didn't pay, but you make a payment arrangement next day, you're still late. But the Equifax on the full report doesn't show you're late because in theory, you made it up the next day because Equifax reports every month, right? So internal, you're still late, meaning internal, lenders still look at you, you have NSF and you're still late, right? So then back to the conversation, 3 days before, make sure then you pay off the full balance. Best is always pay off the full balance, right? So 250 and then 250 now goes 5. Now if 250 you pay half and then on the 16, 17, 18, 19, 20 or whatever, you spend another 250, now you're back to 500. Well, make sure again 3 business days before the due date, pay it full, right? Best is pay it off. Yeah, best is always pay off. There is a certain percentage that you can stay below the threshold, which is still good, but always best to pay it off.
Mm-hmm. One hack I often hear is that don't spend more than 30% of your credit limits. Meaning if I got like 1,000 limits, I should only spend like 300 a month. It's like everywhere. So is it actually true? Is it like a correct statement to like a way to build your credit?
So that's a false statement. What you have, does the lender will obviously what you approve for the limit is what you approve for the limit. That means the lender or the bank or whoever it may be does not limit you then to only use 30%. Otherwise, they look at you as a bad debtor or a bad credit person. That is absolutely false and it's not true. It's back to what I said, is make sure at the end of the month or the due date, you are able to pay it off. The lending world just treat it as it's just basically, it could be anybody, right? It could be you as a friend lending money to another friend. Well, now you became the lender. Your friend became a debtor. And it's just whatever the promises are made or the agreement is to make, which credit card states, by the due date, make sure you do pay. If not, interest will cure, and credit obviously will affect. But if you do pay on time or pay a little bit earlier, then you're okay. So that statement, it is not true. You can absolutely use the full amount. If it's 1,000, go ahead, make your purchase, use full 1,000. But if 3-4 days later I can pay it back, well, why would it matter? It does not matter at all. Now, however, why credit utilization is such a little, actually is one of the biggest factor to your impact to your credit score is because, again, it's back to the whole behavior in credit. Okay, when you have a very high credit utilization, lenders or myself as a credit analyst will start to look at, is this client gonna have trouble paying off? Because that's why there's debt, is debt after debt adding more debt, debt adding more debts. So the higher the amount, we all know here, it's going to be a lot more difficult to pay it off. A lot difficult to really go get a lump sum unless we all win a lottery, right? Or a lot of people do borrow other money to pay off this debt, right? There's always good debt and bad debts, but that's another episode we'll talk about.
That's such a complex topic. If they want to, say, make a big purchase, and then they're already using like 100% of their credit, they still want like a car loans on top of that. that's kind of like the situation that actually matters to the lenders.
Absolutely, yes. Yep, it does matter. If you already, if your credit utilization is already high, even that's why they set as 30%. 30% is it's a threshold where lender feels okay still. Okay, in the mortgage world, or in most, yeah, I would say mortgage world, that's why when you hear a lot why people have to put 20% down or higher is, again, once you max borrow the amount that was lent to you, to them, again, it's about the lending. It's about all banks are very conservative. They always tell themselves, well, what if you can't pay? What if you won't pay on time? What if you go file consumer proposal? What if you go debt consolidation? Then my money is gone, right? Or I'll never see that money ever again. Or if I do see the money again through lawyers and consumer proposal, it's a small fraction amount of what you agreed to pay me back, right? Because understand, when lenders lend money to people, they're lending to strangers, right? If you go ask your mom to lend her money, what will your mom say? Even, like, put it this way, even friends and family hesitate. What makes a stranger from a lender don't even know about you on anything? All is just based on your income, your status in Canada in this case, maybe in North America or wherever maybe, and really your credit, behavior. Based on just that, it's a tough one. It is tough, right?
Does that make sense to say that, like, the banks are always thinking of, like, the worst case scenario?
100%. They always think worst case scenarios. They always think you'll never pay them back, because the prime example that the whole world just went through, COVID-19. Who expected that? Right? All the debts just accumulated. Over 63% in the law firm of consumer proposal increased. I think it was more than even 63%. They were saying it's pretty bad. But who anticipated that?
Exactly.
Nobody. Right? So everybody got laid off. Most business besides the essential got shut down. So yes, they always think of worst case. They don't care who you are, what your title is, how much you make. It's always, what if you can't pay it back? What are my risks?
In the next episode, we will be talking about people who are self-employed versus people that are working full-time. How do lenders see them differently, and what they should pay attention to?
End of the month, I'll be giving away $200 cash to one lucky person. All you have to do is like, share, subscribe, and comment, and tell me what the money is towards. Let's build a better credit together.